The Federal Reserve just sent a very weird message. On one side, the Fed said that the US economy is doing really great, unemployment is very low, and it seems like the US economy is in a very good position. On the other side, the Fed said that we are not going to lower down interest rates. And that actually raises a lot of questions. Does the chairman of the Fed hate Donald Trump so much that he does not want to lower down interest rates when he is president? Or maybe there is something else. Everybody at this point wants lower interest rates. For the last 3 years, interest rates were extremely high, and that forced mortgage rates also to be really high. So a lot of people cannot possibly afford a house, which is why everybody is simply watching at the chairman of the Fed and asking him, when exactly are you going to lower down interest rates so that finally we can go and buy a house, so that finally we can actually have a roof over our heads? So let's figure out, why did the Fed kept interest rates unchanged, and when exactly the Fed is going to lower down interest rates? Now, if you look at the US economy, it is doing far better than any other major economy. Yes, there was a negative GDP quarter back in the first quarter of 2025, but it quickly rose. If you compare the US GDP growth, for example, compared to the European Union, suddenly you see a very clear difference, that the US economy is growing and the European economy is barely growing. If the European economies are going to hit a 2% GDP growth rate this year, it will be fantastic for them. On the other side, the United States is looking at 3% GDP growth. If you compare that to United Kingdom, the exact same story repeats over here. If the UK will grow by 2%, I will say that the UK is doing a fantastic job, but I don't think that is happening. So given the fact that the US has such a strong economy, why didn't it lower down interest rate while the rest of the countries such as European Union and the United Kingdom already have lowered down interest rate? What exactly is wrong with the Federal Reserve? And that's because the United States is preparing itself for another major crisis. In fact, I would say that the Federal Reserve is preparing the US economy for another major crisis. The nature of the economies is that they go through cycles, and if you think that another crisis is not going to happen, then you are delusional, because the economy consistently goes through periods of high growth and then depressions or recessions or major financial crises. That is simply the nature of the economy. So whenever you're going through a crisis, yes, you can borrow a lot of money. But when you're going through very hard or good times, I would say, it is time to prepare the US economy for another crisis. And that's exactly what the chairman of the Fed said.
We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments.
The debt to GDP ratio is already much higher than it was during the peak of World War II. When World War II was over, the debt to GDP ratio was 106%. And back in the days, we did not have intragovernmental debt. So this was the total debt. Now, if you compare this number to today, and you also consider intragovernmental debt, then it is going to be 115%, which means that the United States has accumulated more debt during peacetime than during the greatest crisis in the history, not just the United States, but in the history of the world. The second problem is, of course, the balance sheet of the Fed, and I have talked about this multiple times in previous videos. What I want you to pay attention over here is that since the creation of the Fed in 1913 until 2009, the balance sheet of the Fed was at $900 billion. That means that much assets the Federal Reserve has purchased from the economy or from the government of the United States to issue that many dollars. Since then, its balance sheet has skyrocketed from $900 billion. At its peak, it was $9 trillion. Currently, it stands at $6.7 trillion. So, with these circumstances, if we are going to have another major crisis, then the entire bond market is going to collapse. What you need to understand is that the bond market is the foundation of the US economy. If it cracks down, the entire US economy is going to go into a 1929 style depression, maybe way worse than that, because this time the economy is much bigger and much deeper integrated into the global economy. So if the bond market collapses, it's not just the US economy that will collapse, but the entire global economy. But If another crisis is going to happen with this kind of debt to GDP ratio and this kind of balance sheet, the Federal Reserve no longer can intervene and save the economy. So while we are during the good times, it is important for the Federal Reserve to lower down that balance sheet, prepare the US economy for another major crisis. If we are going to get into another recession in a year or 2 or 3 from now, we are ready. If there is going to be another pandemic, the United States should be ready. With this kind of balance sheet, if it's going to rise dramatically again during another crisis, house prices are going to explode. If you think that buying a house now is expensive, imagine what happens when we are going to explode this balance sheet yet again. So the real question is not how the Federal Reserve is preparing the US economy for another major crash. Now, if you look at the economy, it works in cycles. Back in the days when we did not have quantitative easing is the Federal Reserve simply massively buying off treasury bills in the open market and mortgage-backed securities. During the days before the 2008 financial crisis, the Federal Reserve used to manage the economy and the dollar through interest rates. But since 2008, when we are going through any kind of a crisis, the Federal Reserve steps in and it starts buying a lot of treasury bills from the government to help the government of the United States to borrow a lot of money at very low interest rates to stimulate the demand within the economy. And it also buys a lot of mortgage-backed securities. If the Federal Reserve is not going to step in and buy that many mortgage-backed securities, then mortgage rates would simply skyrocket to the roof, and that will make it impossible for the vast majority of Americans to buy houses. Because if you literally pull out the statistics, it's very clear that the vast majority of people buy houses with a mortgage. Without a mortgage, most people cannot afford them. But when you're already out of the crisis, it's time to fix the balance sheet. And that means that all of the mortgage-backed securities that the Fed purchased during a crisis, it's now to sell them to investors. But the only way you can sell them to investors when you have low inflation. With high inflation, not a single investor is going to buy them. So to understand how it works, let's take a look at the balance sheet of the Fed. At its peak, it was $9 trillion, and since then, it began to reduce its balance sheet. In fact, it's called something like Federal Reserve's program to reduce the balance sheet. And this was basically the plan in 2022, that here's what we're going to do. We have $9 trillion, and if we want to be ready for another crisis, we got to get this number to the pre-2022 level, and that's around $4 trillion. So $5 trillion of mortgage-backed securities and treasury bills must be sold in the open market to real investors. And that's how we prepare the United States for another crisis. So if we're again over here, another crisis hits, we can again print so much money and fix the economy. Here's the plan. We're going to sell $60 billion worth of treasury bills in the open market every single month, and another $35 billion worth of mortgage-backed securities. So within 2 years or so, we should solve this problem. However, when the Federal Reserve pumped so many treasury bills and mortgage-backed securities in the open market, it got a reality check. It found out that nobody wants to buy that many treasury bills at such a low interest rate, and nobody wants to buy mortgage-backed securities at such a low interest rates. That is why it revised its plan and came up with a completely new plan. And here is the new plan. Instead of selling $60 billion, we're only going to sell $5 billion, because if we're going to sell more than 5, the bond market can collapse. You see, the Fed has trillions of dollars of treasury bills. If it dumped them instantly into open market and there isn't enough demand for them, what do you think is going to happen to the yields of the treasury bills? They will skyrocket, costing the government a lot of money to refinance its debt that it does consistently. So in order to prevent that and help the government not to be able to raise money at a lower interest rate, it dropped that number from $60 billion to $5 billion, which means that it is going to take the Fed much longer to get rid of all of these treasury bills. On the other side, even though that mortgage-backed securities have a much higher interest rate compared to the treasury bills, instead of $35 billion, it could only sell $15 billion. By looking at this plan and looking at the reality that the Federal Reserve has faced, do you think it will take the Fed just a year or two to get rid of all the securities that it purchased during COVID? Well, of course not. It's instead of selling $60 billion, you're selling $5 billion, it will take you far longer. Instead of selling $35 billion of mortgage-backed securities, you can only sell $15 billion worth of mortgage-backed securities. It will take you far longer. And if you think, why doesn't the Fed simply sell them in the open market? Do you know what's going to happen if the Federal Reserve is going to sell far more mortgage-backed securities than there is demand on the other side? Mortgage rates are going to explode. So if you think that 7% mortgage rate is really high, then it's going to be 10%, 12%. That is unsustainable. So you can say for a fact that right now, the Federal Reserve is doing everything possible and it's trying to balance between making sure that your mortgage rate is not going to go above 7% and at the same time reduce its balance sheet in such a way that the United States will be ready for another crisis. So it took the Federal Reserve 3 years to get out of the economy and sell $2.3 trillion of securities and another $2.7 trillion left, which means that it might take the Federal Reserve at least another 2 years to sell $2.7 trillion of securities to be able to empty its balance sheet to the level that was pre-COVID. So based on what we know right now, the real question is that when will the Federal Reserve lower down interest rates? If you look at the numbers, you will see that at the end of 2024, the Fed did actually lower down interest rates. And that leads you to ask yourself a very simple question. Well, why did the Fed lower down the interest rates at the end of the last year when Biden was the president, and the Fed is not willing to do that when Trump is the president? This must be political. The chairman of the Fed certainly just hates Donald Trump, and that's why he's not lowering down interest rates. Now, if we're going to be honest about it, we have to take a look at the data. If the Fed is selling a mortgage-backed security that has a 4% interest rate, now in order to sell it to some kind of an investor in the open market, that investor must be convinced that inflation is low and it's going to continue to 2% rate, right? Then it makes sense. If that investor is going to believe that inflation will go to 3% or 4%, then he's not going to buy the mortgage-backed security. Number two, if GDP is growing faster, then the economy is growing faster. That gives faith to the investors, so they're more likely to buy the treasury bills and the mortgage-backed securities, which will make it much easier for the Federal Reserve to get rid of its balance sheet. So it's in the interest of the Federal Reserve to lower down interest rates because it's going to just make it easier for them to empty its balance sheet. In 2023, inflation is 3.4%, GDP is 2.9%. With this kind of numbers, it is impossible to lower down interest rates because inflation is growing faster than the GDP. With this kind of dynamic, it's not possible for the Federal Reserve to lower down interest rates because it cannot possibly sell that many mortgage-backed securities and treasury bills. And that's why it revised its plan. And instead of selling $60 billion of treasury bills in the open market, it reduced that number to simply $5 billion. Now, in 2024, the dynamic suddenly changes. Inflation slows down from 3.4% to 2.4%. And GDP stays pretty much at around the same level. It slightly drops by 0.1%, but that's insignificant. So it's pretty much around 2.8%. But with this dynamic, GDP is growing faster than inflation. That is why the Federal Reserve is like, well, it is possible to lower down interest rates because if we lower down interest rates, we're going to stimulate some kind of growth. The GDP starts growing faster, and that will make it easier for us to sell the securities that we have at our balance sheet. So the trend is very clear. Inflation is down, GDP grows. And now the next question is that what is happening in 2025? If you adjust inflation over the last 12 months, it is 2.7%. Let's compare that to 2024. It was 2.4%. So inflation clearly has risen. When inflation is rising, it is much difficult for the Fed to sell treasury bills and mortgage-backed securities. Secondly, GDP, yes, it has slightly grown from 2.8%, but that growth is not significant. So the trend suddenly changed. GDP is still at the exact same level, but inflation is rising, which makes it very difficult for the Federal Reserve to empty and reduce its balance sheet. And that's why if you want to know when the Federal Reserve is going to lower down interest rates, All you have to do is to look at the main indicators. It's very easy to make this political and hate somebody and throw some words, but if you look at the data, suddenly it becomes clear. When Donald Trump became the president, nobody really knew that he is going to be so chaotic with his policies. Now, you can love that or you can hate that. That's a completely different question. You can be a MAGA supporter or a non-MAGA supporter. Again, that's a completely different question. You might think that it's a good thing for the economy or it's a bad thing for the economy. Again, that's a completely different question. What is important here is that based on what kind of data does the Fed makes a decision to either lower down interest rates or increase the interest rates. That's it for today. Don't forget to check the links in the description of this video. Thanks for watching, and I'll see you in the next one.